Okay, so Brent crude is knocking on the door of $100 a barrel, and the entire energy sector is just on fire. But here's the interesting part. While the rest of the market's kind of sputtering, a giant like Chevron is just taking off, up over 30% year to date. So is this the ultimate way to play high oil prices? We're going to break down the numbers, the strategy, and yeah, the risks. Let's get into it.
First things first, to really get Chevron, you have to understand the world it's playing in. And right now, that world is, well, it's a geopolitical pressure cooker.
You've got three main things creating what some people are calling a pricing supercycle. First, you've got escalating conflicts threatening actual crude output. Second, all that instability is squeezing global supply chains, which adds risk and cost. And the result? Brent crude is pushing that $100 mark. For a company that pulls oil out of the ground, that's just pure revenue gold. In this kind of environment, secure, Western-aligned producers become incredibly valuable. So, in this chaotic world, how is Chevron planning to not just survive, but actually win? Well, they have a very clear strategy, and it's all about a two-front growth engine. And this is where it gets really smart. Chevron isn't running away from the risk. They're actually using it. Take Venezuela. If sanctions get eased, that gives them a super profitable hedge if other markets get tight. And over in the Eastern Mediterranean, their assets there provide supply security right next door to a major conflict zone. So you see, they're not just drilling for oil, they're playing chess on a global map. And that whole grand strategy really just boils down to these two powerhouses: the massive long-term game with the Hess acquisition in Guyana and the fast, flexible cash cow that is the Permian Basin right here in the US. Let's break that down a bit more. The Hess deal? That is all about offshore mega projects. I mean, we are talking about a generational asset here, with a huge amount of oil and incredibly low costs once it's all up and running. But then you have the Permian Basin. That's onshore shale. And this is all about speed. They can dial production up or down super quickly, which generates steady, predictable cash. It's really the perfect balance, a long-term vision with short-term firepower. Okay, but a vision that big? Well, it doesn't come cheap. So let's flip the coin and talk about the bear case, because there are some very real price tags and risks that come with this level of ambition. First up, shareholder dilution. To pay for the Hess deal, Chevron is issuing 217 million new shares. So what does that mean for you? It means your individual slice of the company pie is getting smaller. Simple as that. And it's not just new shares. The company is also taking on over $16 billion of debt from the deal. That is a massive amount of weight to add to any company's balance sheet. And right here, you can see the full shock to the system. I mean, just look at that jump in shares outstanding, from under 1.8 billion to over 2 billion. And at the same time, the debt load goes from pretty manageable to, well, a lot bigger. This is the upfront price Chevron is paying for that future growth in Guyana. On top of all that, those crazy high profits from 2022, they are firmly in the rearview mirror. Back then, the company was pulling in a massive 14.4% net margin, but the forecast for 2025 is a much more normal 6.5%. So, as investors, we have to look at the company based on this new reality, not that wild post-pandemic year. All of this leads to a short-term hit on efficiency. You can see it right here. Both return on invested capital and return on equity are expected to squeeze down. In plain English, the company's getting way bigger with all these new assets and debt, but the immediate cash it's generating from them hasn't caught up yet. So that's the bear case: dilution, more debt, and shrinking margins. It sounds pretty rough, right? But the bulls have a powerful comeback, and it all comes down to one thing: a fortress of cash flow. And these numbers for 2025 are just staggering. Chevron is projected to generate nearly $34 billion in cash from its operations alone. That is an absolute monster of a cash engine. It covers the $15.5 billion they need for new projects, it completely funds the $12.75 billion dividend, and it still leaves almost $12 billion left over for share buybacks. By the way, if you're finding this data-driven breakdown helpful, do me a quick favor and hit that like and subscribe button. It really helps us keep digging into the numbers for you. And those buybacks are so important. Remember the 217 million new shares we were just talking about? Well, share buybacks are the direct counterpunch to that. The company uses its own cash to buy its stock off the market. That reduces the total number of shares out there and makes your remaining shares more valuable. It's the direct answer to the whole dilution problem. And you know what? This cash flow story only gets better.
You see, 2025 represents peak spending. That's the year they absorb Hess and finish up big projects. But look what happens after that. Capital spending is projected to fall, kicking off what they call a harvesting phase. They're basically setting the stage for a tidal wave of surplus cash starting in 2026.
Okay, so we've looked at the big picture, the company's two-front strategy, the pretty serious bear case, and the powerful bull rebuttal. So let's pull this all together into a clear framework so you can make a decision.
First, just look at the track record. This is not management's first rodeo. Over the past 5 years, a super volatile time for energy, Chevron delivered a 90% return. That's more than double what the Dow Jones did. It proves they know how to handle their capital through the ups and downs.
So what about the valuation today? Well, looking ahead at 2025 numbers, the price-to-book ratio is a pretty reasonable 1.64. The working capital is solid, and most importantly, even with the Hess deal, the debt-to-equity is a very manageable 0.70. The foundation of this company, its balance sheet, is still incredibly strong.
So it all comes down to this. The bull case is all about the macro trends, that game-changing Hess deal, and a mountain of cash flow. The bear case is focused entirely on the short-term pain of that same deal, lower efficiency, share dilution, and that spike in debt. It's really a classic fight between short-term cost and long-term vision. So what are the three big takeaways here? 1. 2025 is going to be a messy transition year while Chevron digests this huge acquisition. Expect some turbulence. 2. The dividend is a fortress. If you're an income investor, that massive cash flow basically builds a moat around that payout. And 3. 2026 is the setup. The current valuation could be an attractive entry point before the big spending drops off, which could unleash a historic wave of cash and buybacks.
And that's our data-driven look at Chevron. But now we want to hear from you. We build these explainers based on what you guys want to see. So here's our question for you. What two companies should we break down and compare next? Drop the exact ticker symbols in the comments below, and we will get to work on the analysis. Thanks for watching.